All right. Welcome everybody to Mice Investing Live. Here we are. This is a little bit of a restart. I don't know if anybody particularly showed up to the initial stream initially, but I had a little bit of some technical difficulties getting the stream going. But here we are with the restart. As I kind of had started off initially saying, I was saying here we are with the kind of new time slot here in the Sunday afternoons. This was the kind of results of the polls we did for times for our streams we did on the community tab, which if you are watching live on the replay, please go and check out the community tab and vote in those polls if you have a preference for a specific time slot. There was a little bit of a split vote between Friday and Sundays afternoons as an option. And I was saying how I was switching around the schedule between my school schedule and my part-time job to try and rearrange it so that both Friday and Sunday would be an option going forward, depending on when we can get our audience basically the most together. We'll see how that kind of plays out over the few weeks. So here I have my portfolio year to date up against the S&P 500 year to date. You can see the S&P 500 is now down to only up about 4% or so on the year. Obviously it came up pretty significantly, but it's kind of come back down a little bit in the last week or two. My own portfolio has come down pretty significantly as well. It's also worth noting that I had shown this chart in the last few weeks, and there was actually some errors that were going on in this kind of like section of the graph. When I had made an error in the calculation of the return, not accounting for the inflows into my portfolio from new money being added. So that was a little bit of an issue that had to be corrected, which meant my actual returns a little bit lower than I thought it was. It did seem like I knew I was doing well this year so far, but I was definitely thinking that it felt better than I thought, which, yeah, usually if something feels off, there's probably is something off. But yeah, so either way, still doing better than the S&P 500, but not necessarily as much better, relatively speaking, compared to what we had thought previously. Still hoping to do better moving forward. Interesting to see how it also narrows as we come in a little bit here. So also one other thing, we have the model portfolios, as we've been kind of taking a look at here on our weekly live shows. You can see that the undervalued portfolio is up 15% so far this year, and that's not something that has a mistake due to cash inflows being calculated. There's no cash inflows being calculated here at all. 15% up, ridiculous. That's pretty crazy. Up almost 16% for the total return weighted model portfolio, and up almost 6% for the long short, which is slightly tilted to the long, but is mostly just an even long short portfolio. As we've kind of talked about netting out the sample bias through the equal weight sample that we have here, we actually end up with about 5%, 5%, and 6% if you net out the sample bias, which gets us an average of about 5.5%, showing that the research we did last year is so far doing much better than you would expect, given if it was a random sample of companies selected. And it's also doing better than the S&P 500 on just a total return basis, and even just the net of sample bias is doing better than the S&P 500, and that's not even really the comparison to be had here. So either way, our model portfolios from last year are all doing pretty great. In fact, they're doing better than my portfolio pretty significantly at this point, which, I mean, goes to show that maybe you should you should take my own research as kind of more of a random sample, and maybe not even lean towards my own biases even within my own research, because that's basically what we're doing. You know, it's like I have my portfolio, which is just a few selection. It's basically the top favorites that I selected from this overall list, and obviously this overall list, when weighted specifically in this particular fashion, is already doing better than even my portfolio, and this is just about 20 companies or so, 18 positions what we currently have. So anyway, moving on from the model portfolios and my own portfolio and the returns that they've had so far in the last year so far, or so far this year so far, you know, doing pretty good. Also taking a look at the weights of my portfolio, we've done a little bit of some changes in the portfolio this week. As I talked about a little bit last week, I was saying how Smith & Wesson was likely going to overtake Fidelity as my number one position in not too long, and that did happen this week, partially because I bought a little bit more Smith & Wesson, but I actually also trimmed a little bit of my Fidelity position, which we'll get into some of the specifics surrounding that. Obviously, you can see the slice is still larger here because this is the market weight pie, where I like to order my positions based off of a cost weight. So Smith & Wesson is now my largest position based off of a cost weight, but Fidelity is still a larger position in total market size. And I just realized I didn't actually switch some of the other colors on here. This was the previously the color for Corsair, but I also sold out of significantly a portion of my Corsair. I sold out about half of the position of my Corsair, and I'm probably going to be trimming out the rest of that moving forward. That's something that people have commented on many times in the channel over the last several months, asking me about my position of Corsair. Both asking what point I might hold it till, also asking me what mistakes I made in the original purchase of it, which I've gone over plenty of times before. Certainly massively over purchased on it, but the point is that you have to think about returns moving forward, not thinking about the price you paid. If you get locked onto a price you paid, you'll end up chasing something all the way into the ground. But the point is having evaluated the potential market for Corsair, with me reevaluating all the companies in my portfolio, I decided that one had less opportunity moving forward, which, like I said, we'll get into some of the specifics of that once I get over to looking at the dashboard here in a second. I just kind of wanted to at least show the kind of change in the weights a little bit here, as it's already happened. That's really the only major thing that happened in my portfolio this week. Like I said, selling out about half of my position of Corsair and then trimming a little bit of Fidelity. Then I bought a little bit more Smith & Wesson. I bought a little bit more of Interfor, which I've also been buying up a lot more regularly. And then really, I've just been evaluating the other companies in my portfolio and also rethinking the overall strategy about how I'm allocating everything. Hence the title of the stream today. I actually basically redid my entire setup as far as how I think about portfolio allocation. Kind of created this little box down here, this little table, which I'm gonna make a much more formalized version of it, but this is kind of something I loosely threw together last week. But basically, I put together a new set of criteria that I'm going to be deciding my position allocation size off of. This is a little bit of a different setup compared to my previous rules for deciding allocation size, which had to do with the value score metric that I used in my watch list. I was using the value score metric not only as the tool for deciding what the best investments to buy were, but I was also allocating my positions based on that. And then, having thought about this, I've decided that I'm no longer interested in using the same tool for two different purposes. I'd rather compartmentalize the specific results that I'm trying to get, whether it be for allocation or for actually selecting companies, and then have different criteria for each of those things. And so with that in mind, like I've kind of been talking about, I've been using the percentile as kind of the replacement for the value score in terms of thinking about positions to buy, but that means I did need to come up with a different set of rules for how I'm going to be allocating positions that I have already purchased. And so I came up with this kind of new set of lists. That is that I'm basically going to be first, I created a range. What I did here is I'm basically going to say, as a base, I'm going to assume that I want a position to be at least 5% of my portfolio, and I don't really want it to be more than 10% of my portfolio. So 5 to 10% is kind of like the baseline position size that I'm going to assume it. And then based off of whatever the expected return is, I'm going to assume that at 5 to 10%, that's about a 10% expected return. Any amount over 10%, I'm going to add more position size weighting potential to it based off of the fact that it has higher potential returns. And then beyond that, it gets into a lot less like specific monetary factors, more like qualitative factors, also risk measure factors, some of them kind of macro based, as you can see here. I'm going to decrease position size if it is a foreign company, a company that's not in the US, Canada, or the UK. Why Canada and the UK do I include those? Well, because I feel confident about the legal system in Canada and the UK, much to the same level of degree that I do in the United States. That's a personal choice. Obviously, you can be anti foreign stocks to the max if you want, but my personal way of dealing with country risk is that I'm going to treat Canada and the UK effectively like their US markets, because in terms of how the markets work, I trust their legal systems to operate roughly equivalent, even though it has other factors. I am also going to decrease position size if it's in even worse market based off of the economic freedom score done by the Heritage Foundation. I originally was thinking about basically decreasing position size if it's like an emerging market, but having looked at the list of emerging markets versus domestic markets, I decided I didn't really like that list too much. It feels a little too overly pigeonholed by region. In some countries that deserve to be a lower risk that are still considered emerging markets, or some countries that deserve to be higher risk but are still considered domestic markets. So I decided to rely on a specific numeric measure that can allow me to judge that a company or a country has extra risk to investing in it, based off of that freedom score number. I'm also going to increase position size if it's an over-the-counter security, if I have buy and sell fees either direction on the trade, if it's a relatively small company by market cap size. If it's less than 1 billion, we'll probably decrease the position size. If it's less, all the way down to 100 million, I'm not really going to buy companies that are less than 100 million. If it's a recent IPO or bankruptcy, if it has a negative book value, if it has no shareholder returns in dividends or buybacks, if it has negative excess returns, if it has a low EBIT to net interest ratio, which is interest coverage ratio, if it has high levels of net debt to EBIT, so high total levels of debt, if it has high inventories, if it has low cash levels, if it has low insider holdings or overly large insider holdings, because I don't really like overly large insider holdings either. Like more than 25% is a little bit worrisome, because then at that point they could start to manipulate the stock price. And also high institutional ownership. Yeah, so kind of just a quick overview of the random kind of list of criteria that I'm now built a table to allocate my positions based off of. You can see like these are all my companies up here, and I basically cross-reference all of these factors with various points for each of those companies to come up with my new allocation sizes for those positions, which I'm probably going to be tweaking this over the next few weeks and months. It's a new tool, and it allows for a lot of variability, and it's very tweakable compared to the previous metric, like the value score. As I was talking about, that metric I was using previously, I had kind of hard coded a system in that didn't allow for too much adjustment, and that was kind of creating problems for me. So this new system is kind of going the entirely other direction, and allowing for a lot more variability and changeability over time. If there's one thing that I don't like in here, I can get rid of it and I can replace it with something else if I want to. So we'll kind of be tweaking that as we go a little bit moving forward. But either way, like I said, the goal was to kind of rethink not just my positions, as kind of I was talking about last week. I have been rethinking a lot of my top positions, both whether or not what I think the value is, how I want to hold them, how much what my strategy is with them moving forward. But beyond that, I had to think about, okay, now what's the appropriate position sizes for them. If you're rethinking the positions, you should probably rethink their sizes as well, and you should probably adjust their sizes accordingly, even if they have a relatively good value to them, which in some ways gets us to I'll actually skip over to the dashboard. You can see there's also some other changes compared to last week. When I was looking at this and I was discussing some of the changes in my top positions, one of the things that we discussed was Fidelity, which had been and had been my top position for quite a long time. And I had shown in the last stream last week that my value for it was basically around its current share price, that I was finding that it was currently around fair value. And you can see now this week, it's back to being about 32% of upside. So anybody who's watching this that also watched last week and then also watched the week behind that is probably like, wow, what's with the roller coaster in Fidelity's value? Like, what's going on here? Do you have any idea what they're worth? And it's like, well, I made a mistake in my new templates. I found a little bit of a mistake in the coding that I had done in the spreadsheets that was affecting the way the value came out. And so that was a problem that existed in all of the companies. It was something that existed in all of the spreadsheets I had made, but the new spreadsheet tools have a lot of different options in them, including literal checkboxes and options that you can select that makes the value work in different ways for different companies. So the point is even though that error existed in the spreadsheet for all of them, it wasn't actually going to show in the value unless you had specific options selected. And that was only true for a handful of companies in the dashboard, the Fidelity being one of them. It affected the value for Fidelity. It also affected it for FG, as well as Buckle, and was there another one in here? Oh, and Turtle Beach. That's right. I think there might have been one more in there somewhere as well. But there was a few companies that it was affecting. And specifically what the issue is that the cash in the company was not getting added back to the market cap when we were adjusting from the enterprise value to the market cap here at the end process of the valuation. Well, you build up to the enterprise value based off of the operating incomes that you convert into free cash flows, and then you subtract out debt and you add back the cash to effectively bring it back down to the equity value. But there was a problem in the formulas that was not adding the cash back. So that had a pretty substantial effect on the value, depending on how much cash the company had, which Fidelity has a pretty substantial amount of cash. So that's why it affected Fidelity in such a heavy way, whereas it didn't necessarily affect some of the other companies in the same way. For example, like I said, Turtle Beach was one of the other companies that was affected, but Turtle Beach has almost no cash on hand, so that wasn't really going to affect them that much. And plenty of the other companies, like I said, it wasn't affected because there was different options selected that was bypassing that problem altogether. So anyway, the point is you live and learn. You make new spreadsheet tools like I do all the time. You're always trying to upgrade your spreadsheet tools. Inherently, that means that there's gonna be mistakes in them from time to time. There's gonna be little errors, and you're gonna have to adjust them as time goes on, and try to fix them. And hopefully, you don't trade too much money dependent on those things. Here, hold on just one moment. I'm getting a signal from the YouTube app that there's maybe some issue with my connection. I want to try to fix that before we go on. Hold on. How did I catch the error? By looking at this page right here. This is the kind of like final valuation page that I have, and eventually I was just kind of looking at it, and it just kind of clicked. Because like right here, for example, at the bottom, this is where I have the cash flows, or at least the expected case cash flows put out. And then I have it comes up to the enterprise value, and then I have the net cash market value listed here, which is the net cash market value is the market value of debt plus cash. And oh, it looks good. Thanks. Good to know. So, sometimes YouTube just gives you these notifications saying there's an issue, but it could have been literally just for like 1 second that the issue existed, and I can't tell the difference. So yeah, thanks for letting me know. But yeah, so the point is right here, eventually I realized that this number was like way off, because like also on the main page, the valuation, I have the actual market value of the debt. And eventually I just saw that it was wrong. I was just like, wait, why is this number wrong? That doesn't make any sense. And then I went back through the formulas enough times till I found the error. And then I went back through all the other spreadsheets and realized, oh, this error is in all of them. And then I corrected it in all of them and saw that it was only affecting specifically the ones that I had, like I said, certain options on. So it's like, this is just a part of making spreadsheets. You know, it's like there's going to be mistakes, and you have to audit your own spreadsheets. That's like it's a whole process. You know, in companies that handle spreadsheets, often other people will end up auditing the spreadsheets for you, or at least if they're using good practice and stuff like that. So it's like often that can help with those types of things. I am, you know, doing it all myself to a certain extent. So sometimes it takes a while for me to find the mistake. Sometimes you've traded on it a little bit. Like I said, I did trim F&F a little bit this week, and that was before I discovered this issue. And then afterwards I was like, oh, well, I mean, I guess maybe I shouldn't have trimmed. But on the other hand, I decided I was cool with the trimming anyway, because like I said, I had just also come up with my new allocation strategy, and F&F is still over allocated. So yeah, I was like, fine, whatever. We're going to trim F&F. We're going to trim pretty much all the companies down to the appropriate allocation size. That's kind of the goal moving forward. But yeah, so basically, F&F is back in business, boys. That's the long story short. It's that it's still a favorite of ours in the portfolio. It's probably not going to go anywhere. Whereas I was legitimately trying to decide whether or not I was going to get rid of the whole position last week. Last week I was thinking about it. I was like, man, holy crap! I can't believe I was that wrong about Fidelity's value. Turns out I'm not that wrong about Fidelity's value at the end of the day. Well, you know, I was wrong twice. I was wrong when I said I was wrong the first time. That's the situation. But anyway, other companies still kind of looking at this week. I didn't do too much looking at new companies this week. If you do look here closely, though, you'll see that Google and Amazon have indeed been added to the list. I'm probably not necessarily going to be making a video for either of them, and I'm not 100% done with the values either, so I wouldn't necessarily act too much on them. But they're both, I've done decent work on them. I just haven't built a super strong value of a very strong model for the revenues yet. So I mostly just kind of put some pretty broad assumptions for the growth of Amazon and Google in there. But I think I put pretty strong growth assumptions in for Amazon. I was really trying to see whether or not Amazon had really good potential to it, and it just looks like it's still massively overvalued. Obviously, I'm not slapping a very large terminal multiple on there, so that's part of it. But I will say I probably slapped a larger terminal multiple on Amazon than any other company in this list. I'm like the implied cost of capital and growth assumptions that I have in there implied a multiple like 25 or something like that. Whereas typically I'm throwing like a 15 on the end of my valuations. So SBH is never going to happen. Yeah, it may not happen. I don't know. We'll see about that. I am obviously kind of going a little bit slow about pulling these ones together. It still doesn't look bad though. That's the thing. It's like, you know, we can. It's the never-ending meme, but I might get around to it. I'm just trying to finish up building very good revenue models for all these companies as much as I can, and I'm still waiting for a few of the other companies to report their 10Ks. We did get, obviously, like I said, Fidelity did report this week. That was part of the reason I trimmed ahead of the earnings, because I was looking at my previously bad value, and so I trimmed ahead of the earnings. And then they did report, and then they did drop pretty significantly on the earnings. So I guess it would look sort of good from that perspective, even though, like I said, the value is pretty good at the end of the day. And then for what that's worth, we can actually sort of take a look at the assumptions I have underlying that. I did actually pull up in the release from Fidelity. This is their release. We talk about their the overall title revenues right here. Title revenues in the quarter. Or is this for the full year? Yeah, for the quarter is 1.9 billion, for the year 9.1 billion, 1.9 billion for the quarter in Q4. So this is in, you know, the most recent quarter, which theoretically is going to have the most max pain from the interest rate crush as we've kind of gone through. 1.9 billion. If you annualize that up, that's going to be close to 8 billion, but it's like, what is that, 7.6 billion? If we switch over to my Fidelity revenue model that I was putting together previously, you can kind of take a look at the title revenues as they have right here. Title revenues in 2019, the total title revenues was 7.7 billion. So again, we're talking about 7.6 billion is the annualized number of the most recent quarter, and that basically kind of puts them in line with the total title revenues that they had in 2019. Is basically what I'm seeing here. So as far as I'm concerned, that's like them returning back to the trend, right? It's like pre-2020 and all the nonsense that's happened since then, which is when the largest run up in their revenues look like their total revenues went from 8.5 billion up to 10.7, 10.8 billion in 2020. So it's like that's basically kind of getting them back in line, and that's obviously just focused on the title portion of the business. It doesn't say anything to do with F&G, but that is the bulk of their business. Also, another way kind of to look at that is to come down to, or actually, hold on, I have it in the it's in the 10K, or not the 10Q. They have this table down here. Another way of looking at it is in here in this most recent quarter. Make it bigger. Total closed orders, which a closed order is an order from which they're actually going to be recognizing revenue. They open orders, but they typically open more orders than they close, and then there's a certain amount that kind of get canceled in between. So just focusing specifically on the closed orders, 216. If we annualize that up, that becomes what is that, like 870, something like that. Did you read Berkshire's recent annual letter? No, I didn't read it yet. I opened it briefly when Zhao posted it in the Discord, which, by the way, people who are watching live on the replay, like, subscribe, join the Discord, link in the description below. So yeah, I'm pretty sure he posted that here somewhere. I can't remember where he posted that, but major investors. I can't remember where he put it, but yeah, it is. I opened it briefly and only looked at like the first couple pages of it. I didn't really read the whole letter. I kind of got distracted once I saw the what's it called, the little table of the annual returns. Hold on just a second. Now I want to look at it. Where did he put it? Is it in chat and I'm just dumb? Yeah, it is. Okay, let's just open it right now. Yeah, so I got distracted by the total returns table. You know, just looking at this, I feel like Buffett could just post this page and mic drop it, and that would be his whole annual letter, and he could probably get away with it. But yeah, so I haven't read it, but you know, I mean, it's probably mostly just a lot of the same stuff as it is most years, to be honest. As much as I love Buffett, he doesn't necessarily add too many things new. I did actually listen to the Charlie Munger interview. Though the Daily Journal shareholder meeting, the Charlie Munger shareholder meeting. I would check that one out. That one was pretty interesting. It was also pretty interesting hearing Munger give a somewhat sober and honest take about use of margin, because like one of the questionnaires came and like actually gave him a pretty pointed question about his use of margin in the past, and asking that against his criticisms of people using margin stupidly as well. There was a few different questions like that where some people were basically pointing out the difference between things Charlie Munger says and the things he does. And people were asking him a few questions about that. But in general, he gave, the correct answers, which was, if you have enough wisdom, you know when to break the rules. That's kind of like the typical thing. And because like for the specific case that they were talking about was that he used leverage to buy his BYD position that Munger recently got into, and so he was basically arguing that was like one of the best moves he ever made. So it really comes down to that. It's like margin is dumb when you screw it up, but if you pull it off, then everything looks really good. Anyway, so what I was saying, back to the close orders with Fidelity. Total close orders in the fourth quarter was 216,000. So if you analyze that up, that comes to like 870 or so thousands, 870,000 closed orders, and that's on a direct close order, which I have the numbers for the direct close orders going back. In 2019, the closed direct orders was 1.4 million. So we would be a little bit of pretty significantly far below the 2019 levels based off of total close orders, but yet the total revenues are still relatively close to the 2019 levels, which I think just shows the overall change in the dollar amount per order in these things, the fee file, the file per the overall fee on each filing for these refinances. But my point is that the Fidelity earnings look really, really bad, but as far as I'm concerned, it's basically just them returning to trend, which is pretty much what my entire valuation is based off of, is them returning to the long run trend. So as far as I'm concerned, it all looks pretty good to me, is kind of the point I'm getting to. Okay, so let's see. What else do we want to talk about next? Oh, I guess we can talk about inflation a little bit. That's kind of one of the other big topics that has been being discussed this week. So we got the consumer price index up here, as well as the PCE, the core PCE in red, as well as the services less shelter number, which has kind of been the third most new favorite that the Fed has been bringing up. Everybody talks about how the core PCE is the quote unquote Fed's favorite inflation gauge, but in literally just the last 6 months, the Fed in particular has been pointing out this green one as well. The services less rent of shelter measure. And the reason why they're pointing that out is because that basically gives them an idea of how much services are changing, not counting the housing market, because they know that the housing market's going to be going through massive gyrations right now due to their interest rate hikes. So they're trying to read past the noise that is being caused by their interest rate hikes and then focus just on like how much are wages in the service sector overall rising and something like that. So that's kind of the idea of why they're focusing on that measure now as well. But the point is in this last week, we did get a new core PCE number, which was a little bit hotter than expected. You can see right here, 4.6. We went from a 4.6 year-over-year number up to a 4.7 number when, we were trending downward for several months there. So now it doesn't necessarily look like we're moving too much of anywhere. And here, I just zoomed in on the one here, and the red line is the one we're talking about. You can see the red line, it looks like it's hardly moving. It's like, yeah, it's gone down a little bit, but it's hardly moved over the 1 year period, while the green line is still moving up. And that's kind of the point I was saying, like they're focusing on the green line because they see that as being pretty close to kind of like wage growth in a certain sense, or at least the way which wage growth hits the consumer. So while the blue line is going to have a lot of volatility from food and energy and stuff like that, and the red line is still going to have a decent amount of volatility involved in the housing shelter, the green is still kind of peaking through overall. Now, one thing I kind of wanted to think about is like the goal of the Fed versus where they're currently at. Now, I've used this particular table before. I posted it in the Discord a few times before, like 6 months ago, I think, and 9 months ago. But I updated it yesterday while thinking about what I was going to talk about here today. Basically, this table, I put the different interest rates along here at the top, along with different timeframes against different CPI measures. And I wanted to measure what is the current real yield, which is basically taking an interest rate and subtracting out an inflation measure to find out how much is the real yield of something. And I want to see what is the real yields like now versus when they began the inflation fight. And I'm defining the beginning of the inflation fight as the end of 2021. It's kind of an arbitrary point in the sand. It's before they started doing the rate hikes, but it's about like 4 months before they started doing rate hikes. But it's also basically when they started heavily telegraphing that the rate hikes were going to be coming at that point in time. And it's when the market started acting like the rate hikes were going to come. So that's basically why I'm choosing that as my point in time of when the inflation fight began, quote unquote. But anyway, so I have the Fed funds rate here on this column. I have the 3-month Treasury, 6-month, 1 year, 2 year, 5 year, 10 year, 30 year. And then I also even include the 30-year mortgage because obviously real estate is just such a huge player in this overall study. So I have the rates at the end of 2021, and I also have the current rates as of basically just yesterday. Then I also have the CPI as of the end of 2021, which was 6.8%, and the current CPI, which is currently 6.3%. Isn't that pretty interesting to see? To think that it's been 2 years and the CPI went from 6.8% to 6.3% during that time frame during the whole inflation fight. And that's because obviously it went up a whole lot more before it came down. So while it has come down a whole lot, it hasn't come down a whole lot compared to when the fight actually began. Relatively speaking, like I said, I drew a line in the sand. You could argue about that point in time, line in the sand draw. You could do whatever you want with that. But the point is, you can see 7% change. Is basically what we've had there. Now I've done basically the same thing with the core PCE measure, which was 4.8% at the end of 2021, and it's currently 4.7%, which is a 2% decline. Nukit, do you know how to invest in mortgage-backed securities? Not really. There's I know of a few kind of like indirect ways to go about it, but I've never really looked into that too much. In fact, I guess I kind of almost took it as assumed that individual investors probably can't invest in mortgage-backed securities. I don't really, like I said, I've never actually really looked into it. So like, excuse me for talking out my ass a little bit, but I feel like that's probably a class of security that individual investors don't have direct access to, and you probably have to have securities trading licenses to handle. But I believe there are some indirect. I do believe there are some indirect vehicles that you can go about with that. Yeah, like through an ETF, something like that. Yeah, I do think there are some tools out there that allow for things like that, or some corporate structures where I think there's even some like REIT type scenarios where basically they're just trying to buy up mortgage-backed securities. I think there are a few vehicles out there that you can kind of get your hands on mortgage-backed securities and stuff for. But yeah, and then another way to go about it would maybe be to just maybe buy equity in a financial institution that has massive exposure to MBSs. That would probably be another way to go about it. But yeah, I don't think there is a whole lot of direct avenues for non-institutional investors to get their hands on MBSs. But yeah, anyway, so back to what I was saying here. So I have like I said, the change in CPI has been 7% since the end, or since the start of the inflation fight. The core PCEs changed by -2% since the start of the inflation fight, and then I have basically all the individual the individual rates that we talked about, the Fed funds through the 30-year mortgage, subtracting out said rate. So you can see negative yields pretty much across the board when the inflation fight began, and negative yields still across the board, but they're getting a lot closer to zero. The overall change, we actually can see that the change has been pretty significant over time. And then the same thing with the core PC, pretty significantly negative before the inflation fight began, and then still negative mostly, but there's actually a couple positive. And then they're pretty low levels of negative, so they're not majorly negative at all. I took the average of all these measures because, like I said, I didn't want to rely on one specific duration. I wanted to get an overall kind of grasp of like what the real yields are like. Average real yield, the inflation fight based off of CPI was -5.8%, and now it's -1.6%, which means, effectively speaking, compared to the overall change in the Fed funds during that time, about 99% of the change in the real yield came from the change in the Fed funds rate. It's basically the amount that this has changed is basically the same that the amount this has changed. Doing the same thing with the core PCE, we went from a negative 3.8% yield to on average about a real yield of 0%. So in core PCE terms, which is what the Fed funds, what the Fed is typically saying is their favorite measure, right? So in terms of this, this would argue that they're actually getting close to starting to have victory. Or at least going to be getting close to the point where inflation would really start to come down, because you would actually have a real yield, and that's like imperative if you're actually going to fight inflation. But if you compare that to the change in the Fed fund rate over that time, it's about 90% of the change that's happened over that time frame. So basically, what that tells me is that inflation has been starting to come down, but it's only coming down approximately however much that they increase the Fed funds by. It's not really starting to accelerate. Which I think makes a pretty big difference, because a lot of people were arguing that as the interest rates were going to come up, that the CPI and the core PC was going to really crater, and we're really not seeing that at all. Getting pretty late where I am. Going to watch the rest later. Thanks for your thoughts and hard work. See you soon. Later, Nuke. Always appreciate having you on. Thanks. But yeah, so anyway, coming with this measure, what can we do with this? What does this mean to look at this? It's like, okay, cool. Real yields in CPI terms are at about -2%. Real yields in core PC terms are at about 0% now. Well, the target is 2%. I have CPI here, but they're targeting 2% for the core PC as well. And really, we're just going to focus on the PCE anyway. So the point is 2% is what they're trying to get to. If we base it off of the core PC, that means that they need to shrink it by 2.7% more. That's how much more it needs to come down in order to get to their target. Now, I'm going to argue that we will start to get a little bit of an acceleration effect in the disinflation. Now, I estimate this by taking that ratio, that 90% ratio, and I'm basically going to multiply the amount needed by that a few times over, which basically argues that as what that is arguing is that as they increase the interest rates, the PCE is starting to come down at a faster rate, because this relationship is going to start to get stronger. Basically, for the next 2%, maybe it's only going to be 80%, and the next 2% after that, maybe it's only going to be a 70% relationship. And it's a total spitball number. I'm just throwing it out there, but in my opinion, some sort of adjustment for acceleration had to be made here in order for this to be in any way a sort of realistic model. So anyway, the point is instead of 2.7%, I'm going to estimate that they actually only need to bring it down about 2% more for the other 0.7% to effectively do the job by itself. That's basically what I'm saying here. And now the question becomes, okay, well, they're doing this in rate hikes at each of these meetings. How many basis points are they going to go per hike? Well, currently they're doing about 25 basis points. So if you take the 2% divided by the 25 basis points, that gets us 8 meetings required in order to get to the 2% target. 8 more meetings of a 25 basis point rate hike. Now, of course, they could go back to 50 basis points, at which point it would be 4 meetings. But that would still be 8 meetings, 4 meetings. It's still 2% more. Still 2% more, which would get the Fed funds target up to 6.3%. And that's effectively the estimate I'm making here. I'm basically arguing that in order for the core PCE to get back down to 2%, based off of the efforts they've made so far and the amount of results we've gotten so far, I'm going to estimate that they actually have to bring the Fed funds rate up to 6.3% in order to get that, which is 6.25 to 650 is the actual range that would be at. Now, that's a pretty high number. I don't know if you guys have been paying close attention, but the Fed funds is not up there yet. The Fed funds is currently only at 450, 475, and it's expected to go 475 to 450 at the next meeting, and it's expected to go 25 basis points more after that. It's expected to go 25 basis points more after that, and then it's expected to sit still for 2 meetings based off of the weighted average of these assumptions. Obviously, there's plenty of people who are betting to the other side, and then it's expected to go once more up after that. But that means the market so far is expecting it to stop at 575. 575. I'm saying 625 to 650. So again, total estimate here. I could be super wrong on this, but it looks like they have to do a lot more work, in my opinion. How long do they stay in the 6.25 to 6.5 range? Is the goal to stop inflation for a specific amount of time and then lower again to stimulate? That's a very good question, and a question that I won't really have a good answer for. It all depends. I think in their minds, they certainly do hope to have the tool ready again to stimulate. I think that's what they want. I'm not sure. Here's how I think about it. The problem with inflation right now, the reason why it's not going down that fast, why it keeps like dipping up a little bit and then going down and then dipping up a little bit and going down, and is partially because everybody expects them to re-stimulate once this is all over. I think that's part of the issue, is that everyone is kind of pretending like inflation's going away, but in their heads they still have this inflationary mindset where they're still waiting for the cheap money. And so it's like I don't know how long they have to leave it there, because I think it's entirely dependent on investor psychology. And so if we get to the 625 650 point, which I find it funny that the point I say I have to go to is actually the top of this chart right here. Interesting to see that it's just a pre-designated link right here, so there's nothing magical to that, but I think it's pretty funny. But the point is and this estimate, it's worth noting, was like 2 or 3 levels lower only a couple weeks ago, so it's not like this is some wrote in stone estimate or anything. Market participants may wake up to what I'm saying right here in due course, very, very quickly. But the point is if I think that if they actually take us all the way to 625 650, it'll probably cause so much pain to the markets that it might start to actually clean up that mindset. It might start to really actually wipe people's inflationary pictures. And that's part of the issue, is that it's like everyone has to like almost forget what it's like to be in a bubbly market for the real bubbliness to go away. I think your statement a few minutes ago was the market is pricing in stopping at 5%, but your estimate is that they'd have to increase substantially more and we'd be mispriced by 25%. Yes, that's exactly what I'm saying. That is exactly what I'm saying. The market currently expects, based off of this chart right here, which is basically a summary of the Fed futures, the fund futures. So it's based off of the bond market. This is what the bond market says. The bond market is currently predicting that they're going to reach 575 by November of this year, and that's going to be the peak. And then according to the bond market, it actually expects them to start going down the next month thereafter. Like I said, this is just a bond market estimate. Markets are wrong often, right? And that includes the bond market. So there's nothing magical about this prediction, but this is what the market believes right now, is that it's going to go to 575. And I'm saying that it could easily go another 75 basis points higher. And think about it that way. It's like, it's only another 75 basis points. Like I'm not even saying that much when you think about it. Thoughts on long high yield savings, higher cash, maybe a short ETF? All of the above in certain ways. I mean, I'm definitely very, very cashed up. We were looking at the value pies earlier, and I'm super cashed up, much more cashed up than I would like to be at the time being. It's not my target allocation for cash is closer to like 15% right now, and I'm at like 20%. And that's partially because I've been trimming out of positions that I was a little overweight on and less confident in, and I've been trying to kind of coalesce down, but I haven't been able to do enough research to actually uncover enough other opportunities to replace them with. So I have been kind of cashing up a bit, which is, like I said, kind of been caused by that reason. But with all these things I'm talking about with the interest rates, I think it's a good idea to be heavily cashed up. I think it's important to be invested still, but yeah, there's a lot of potential risk in this market because of this. It's like if interest rates don't stop at 575 and they go to the 650, that's gonna cause a significantly higher amount of pain. Because also, it's worth noting that the market has kind of been ignoring the last couple hikes in the first place anyway. Looking back at the last 6 months, the market's kind of been ignoring the last couple hikes in the first place. It's like, I don't know, the value of the market can only go up if interest rates go down or if cash flow expectations go up. So interest rates did not go down, but I don't know why the market believes cash flow expectations went up, because I wouldn't say that they did. What demographic do you think gets hurt the most? Lower, middle, below, upper class trading down? Oh, I mean, it's almost certainly going to be the lower class that gets hurt the most, because they don't really have access to any form of good credit. It's like obviously interest rates hurt anybody taking out any form of credit, but the worse you are in the chain for deciding the terms of the credit arrangement, which typically the poorer you are, the less power you have in controlling those terms, then the worse off you're going to be. The best way to I like to describe this is because like the truth is that poor people don't actually take up that much debt because they usually don't have access to that much debt, but they only have access to very small amounts of debt, and it's usually at very, very poor terms, which is like things like payday loans and stuff like that. Like that's like the bottom level, obviously. So yeah, it's going to be the lower class that deals with the most pain, but it's a very different type of pain that different income groups obviously experience. The type of pain that the lower income class is going to be dealing with is going to have almost no real effect on the markets and stuff, because those people also don't really own any ownership in the market either, for the most part. Most of the lower class doesn't own anything in the market, or if they do, it's like minuscule at most. So yeah, well, definitely lots of risk moving forward in the markets. Flipping over here to the Trading Economics website, we can take a look at some of the economic news that we're expecting in this next week, because we do have plenty of stuff coming in. We have durable good orders coming in on Monday. Durable goods orders is a pretty good kind of like demand measure for future economic growth. We do have consensus numbers for the ex-transport version of the number of 0.1% expected. We'll see if we get a worse number than that. That could be a negative catalyst. It could also be a positive catalyst. Most of the things in here, I would say, kind of go both directions on that. We have pending home sales also coming in on Monday, expected 1% on the month-over-month number. We're going to get retail inventories, wholesale inventories on Tuesday, and stuff like that. Jeff, I keep looking for companies like Easy, PW, and LQDT, trying to find some place where the underbanked would go in a credit crunch, where businesses go when margins tighten. Where the underbanked would go in a credit crunch, where businesses go when margins tighten. I will, because that's kind of two different categories. I would say that I don't think you want to look too hard at the banking institutions that are serving the underclass during the, well, I don't know. I guess it depends on when you're on shots. When you're what part of the cycle is, because like you have to keep in mind that like as we go into some economic pain, those places are probably going to be dealing with some of the worst. Oh well, you're thinking like pawn shops. I'm thinking like actual financial institutions that were like changed them. You're thinking of more like the other end of the table. Pawn shops are going to get stuff during the economic downturn because people are selling to them. Are there any pawn shop stocks? That's a good question. I don't think I've ever actually seen one out there. Is there a pawn shop stock out there that anybody knows about? Pawn shop stocks. Easy PW. Oh, is that's what you're talking about? Yeah, because I've never really looked at that space. 500 mil. The one thing I would be curious to see about this is like what I'd be curious to see what's their business like throughout the whole cycle. That would be something I'd be very curious to see. Because like it could be an interesting thing that has like a huge spike up of business during bad downturns, but I wouldn't necessarily want to be invested in something that only has their good business during that time frame. I would want to find something that is just reasonably counter-cyclical. But yeah, I don't know. Like I said, I have to look and see exactly how it is that they're getting their money, but see what their balance sheet looks like. 200 million in cash, 550 in debt. That's not too bad. Well, I mean, it's a lot compared to their market cap, but decently shorted right now. In the business of helping businesses liquidate their inventory and auctioning it off too. Yeah, buying up receivables and inventories on the discount probably. decent insider ownership. Could be interesting. Anyway, also some more stuff. As I was saying, housing price index numbers are expected to come out on Tuesday as well. And then also we were going to be getting, what was it? There was like one other thing coming in this week. Oh, maybe that was it. Maybe that was all the things I was housing. But yeah, housing numbers also, which could go either direction. Obviously, if housing numbers come in relatively low, I would say that that's probably going to be a relatively bullish number for the markets, because maybe that'll counteract the higher interest rate narrative. But watch the housing numbers come in not that hot or not that cold, or maybe they'll come in relatively hotter than expected, and then that would actually add to the fear of the Fed fire, so to speak. So there's more catalysts coming with the economic data on that front. Let's see. So any other stuff? Any other companies we want to look at? What was that other one you mentioned? LQDT. Let's take a look at that. Liquidity services. Self-directed auction listing tools, value-added service in the United States and internationally, Gov Deals, Retail Supply Chain Group, Capital Assets Group, and Machinio. Interesting. See how their financials are compared to the other one. Real estate housing. Tobias Carlisle is saying the velocity of home devaluation is worse than 2008, specifically west of Texas. It's scary in these next few housing prints. Yeah, it'll be very, very interesting to see how these next few prints come in. And I would say that the housing market is just a very mixed bag right now. So that's the thing. It's like there's still some pockets where it's maintaining its hotness pretty well. But other areas are deteriorating fast, and it's kind of hard to tell the difference between the two. I myself am west of Texas, and I've kind of like, it's anecdotal, but I like in my city area, I try to pay attention to it and try to like look around at all the commercial properties and seeing like which ones are being built, and be like, how long is that one being built? Does this one look like it's getting stalled? And I don't really, that's the thing, is like I've been trying to look for that. I've been trying to see like, do I see a lot of like stalled building projects? Does it look like stuff's kind of like getting like halted up in places? And I'm not really seeing that. I'm in the Phoenix area, just in case anybody's wondering. I'm in the Phoenix area, relatively big city, very, very hot real estate market in this whole this cycle, and it definitely doesn't really seem like it's cooled that much around here. That's just one place west of Texas. I assume they're probably including a lot of California in that, and I do think California is dealing with it a lot worse. Like I said, I haven't visited myself, but yeah. No, you too? Cool, nice. Yeah, Arizona born and raised. Left it for quite a while and came back, but Arizonan born and raised. But yeah, so yeah, it's like I don't know, maybe I don't know if that's your experience too, but like in my experience, like around here in the Phoenix area, it doesn't seem like the real estate market has dried up that crazily. But it also could happen very quickly. So that's the thing. It's like I'm not actually doing any transaction stuff. Like I said, this is just me observing when I'm like driving around or going shopping and stuff, like paying attention. Just trying to pay attention. And it just doesn't feel like the city has like stopped and halted business all of a sudden. And I was in the city around 08 too. I was a lot younger though. I was like when I was like graduating high school, but still. I remember the city seeming a lot deader then. So I don't know. Like I said, California though, I do think is having a little bit of a faster pull down in terms of the real estate numbers though. So that paragraph could have been more about them than the Phoenix area maybe. Northwest Peoria seems a bit slower. Yeah, that wouldn't surprise me. I definitely don't visit the Peoria side as much. I think sellers still think they're going to make bank. Their seller price doesn't match increased interest expense. Their RE price drops are minimal. Yeah, that makes sense. All right. Any other companies you guys want to take a look at? If not, I might call it for the day a little bit earlier than normal. I will say also the I didn't talk about it at all yet. I got into a lot of the details with Fidelity. Let me take a look at my sheet real quick. Yeah. Pull up some names while I'm talking about this other thing. I'll talk about Inter4 for a little bit, and then we'll go back and look at a few more tickers before I pull out. But yeah, so Inter4 forestry. I've had it in the portfolio for a while. Anybody's been paying attention to that. I do think this is probably going to be the next valuation video I'm going to do. Expecting to put that out here this Friday. What with the kind of switch of the live show here to Sunday, that means I'm going to probably have Fridays be the release day for my actual valuation videos. Yeah, so on Friday, that's what we're expecting. Probably gonna be doing Inter4 forestry. It's been in the portfolio. It's still looking good in the portfolio. I put together a pretty solid model. Kind of pulled open some of the stuff over here. Lumber pricing model basically. So I took like the lumber prices basically for the last several decades. I took a track of them over the last 90 days versus the last 10 years. So I have like a 10-year average for the lumber price. I'm basically just gonna assume that the long run lumber prices are on kind of a consistent trend. We have like a whole lot of variability in it. That's kind of why I went to the 10-year average. The 10-year average lumber price is about $392, $393. If you take a look at the overall trends of the 10-year lumber price, if you just take a look over like I said, about 50 years was it? I have about 50 years worth of lumber prices. And a 10-year average going back for 40 years throughout that time frame, and then we look at the COGR over that time frame. So over any 10-year time frame, what is the 10-year COGR of the lumber price? And then I took an average of what those lumber prices are. So basically, it's like saying if we didn't know what time frame we were in, and I just dropped in at some random point in the last 50 years, what is on average the likely growth of lumber over that time frame? And it was about 2 to 3%. 2-3% from the 10-year average. And so I just decided to build a roughly simple model based off of that. That gets me to pretty simple assumptions of lumber prices 10 years from now, anywhere from $446 to $650 or so. And then from there, decided to build up to revenues for Inter4 based off of the production targets that the company themselves has here in this presentation. Let me find that right spot in the presentation, but a little bit lower. Where is it? Like all the way near the bottom, isn't it? All right, that's it. Should have pulled this up earlier. There it is. Yeah, so here's their production for the last several years. They've made acquisitions as well as larger amounts of capital expenditures in the last couple of years. So that gets them up to pretty well guaranteed levels of production that they're going to reach within the next few years. They're hoping to target it for 2027. I'm just going to assume that it takes them an extra 5 years to get there. So whatever, the point is on a pretty reasonable basis, I can assume anywhere from 4.5 billion boards per foot versus 7 billion, which is the kind of roughly average production numbers for lumber. And then based off of that and the lumber prices I got, I come up to a distribution of revenues for the company. You can kind of see the relationship between lumber prices and Inter4 right here with the revenues in the green and the lumber prices in the blue. So you can kind of see the lumber prices move pretty consistently with the revenues. They're about 1/4 offset, which is pretty reasonable time frame worth of difference. And then the blue line versus the green line, that's not the full area, that shows the year-over-year change within that. But that gets me to, like I said, revenues for Inter4 of anywhere from 3.3 billion in US dollars to 4.7 billion, and then I'm building up my valuation from there. But I'm not going to give the full spoiler alert on that though. I mean, you can kind of see it right here. It is a pretty good value. I've been buying it. I bought a little bit this week. I'll probably buy a little bit more next week. Probably gonna be buying it for quite a while moving forward. But yeah, so definitely keep an eye out for that video on Friday. It'll be really just getting started working on it, to be honest, but it'll be out on Friday. So anyway, what were those tickers? Did you throw a ticker out there? I wasn't looking closely. LCII, is that one you pulled up? It's funny, the company that helped me find your channel is WSM. Didn't make the cut in your first video. I'd love to see how they model in the new sheet. Yeah, I might come back around to WSM. I really liked their business. I really liked the platform they have. They had a really good set of internet platforms related to their brands that I thought was really complementary to their actual stores. So yeah, I was very interested in WSM. I would definitely like to look at them again. And yeah, who knows? Maybe with the new model, because there was flaws with the other one, so it's possible that the issues with the old models was present in that particular one. Who knows? Anyway, LCII. So what is this? Recreational vehicles, RVs. RVs, truck boats, all boats. Interesting. AAP, that's another one that's been pretty interesting to me a couple of times. Never really quite gotten around to looking at it, but it's definitely both an industry and a brand that I would relatively like. I think they have a pretty good placement in terms of brand awareness. Pretty juicy dividend. But yeah, they're still up at 17.18 though. That's definitely not cheap, but yeah, it's quality though. So it could be worth it. Who knows? A lot of debt for that cash, that's for sure. WHR. Yeah, WHR. I was very close to doing a pretty solid dive on. Well invested, one of our main members in the Discord. Yeah, he was pretty interested in this one for the longest time, and I never quite got around to looking at it for him, but almost did a few times over. Yeah, I mean, they were expected definitely to be going through a lot of pain in the next year or two. So that was the thing, is like it's such a high quality brand and pretty well managed financially, but it is super cyclical. That's just an unescapable fact for sure. Oh, Warren Buffett bought more Louisiana Pacific. I missed that comment. Not too surprising. Also, a really quality company. Also, was kind of disappointed that one couldn't make the cut too. Man, that chart though, that's insane. I mean, it goes back to 84, but such an interesting chart. All right, then. I guess we'll call it there. Thanks for joining me in the chat. Really appreciate you guys showing up and having the conversation, throwing out ticker ideas to discuss. Like I said, keep an eye out for that video on Friday, and we will go ahead and do another stream at this time again next week. Yeah. Catch you next time. Later, man. Bye. Oh, also, before you guys go, like, subscribe if you're watching on